Welcome back to We Are Cosmic, everyone. I'm thrilled to have you here because today we're diving into something that affects every single person who is invested in cryptocurrencies, especially Bitcoin and XRP. If you've ever felt confused about the market cycles, global liquidity, or what the next year might look like for crypto, then you're in the right place. Today we're going to break down some of the most critical insights from leading financial experts and connect them to what you, as a smart investor, should really know. Before we start, don't forget to hit that like button and subscribe if you haven't yet, so you never miss updates from our channel. The crypto world moves fast, and understanding the bigger picture can make all the difference. So let's get straight into it. One of the big questions everyone is asking right now is whether 2026 is going to be a bear market year. There's a lot of speculation about Bitcoin and other cryptocurrencies, and a key factor to understand is global liquidity. Essentially, 90% of Bitcoin's price movements over time can be explained by global liquidity trends. That means how much money is flowing through the economy directly affects crypto prices. If global liquidity were to suddenly drop, yes, that could trigger a bear market. But here's the catch. There's no current evidence suggesting that liquidity is going to fall drastically this year. The economy, while not perfect, doesn't show signs that policymakers would take such aggressive actions to shrink liquidity right now. Doing so during a year when manufacturing activity is low or during midterm elections with pro-business leadership simply doesn't make sense. Reducing liquidity too fast could risk the bond market, destabilize banks, and even impact the stock market. For these reasons, the assumption that 2026 will be a bear market seems unlikely. Now, not everyone sees it the same way. Some experts, like Raoul, argue that Bitcoin doesn't strictly follow the traditional 4-year halving cycle. Instead, he believes that crypto markets are tightly connected to global liquidity. And historically, he has a point. When you look back at Bitcoin's history, there's a strong correlation with money printing and liquidity flows. This means that as global liquidity rises, risk assets like Bitcoin and tech stocks often benefit. In other words, while we cannot predict exact prices, understanding macroeconomic trends gives us a huge advantage in anticipating market behavior. Today, I'll show you some key insights from Raoul's recent analysis and explain what it means not just for Bitcoin, but also for XRP. These insights are crucial for any investor who wants to position themselves for both the potential down cycles and the upcoming bull runs. It's also important to highlight that no one is correct all the time. Even experts can be wrong, and markets are inherently unpredictable. Just because liquidity is increasing doesn't guarantee that crypto will only go up. Volatility is still a factor, and smart investors know that preparation is more important than certainty. What sets successful investors apart is understanding historical patterns, recognizing risk factors, and having a plan for different scenarios. For example, managing risk during a market drawdown or taking advantage of short-term dips can drastically improve long-term performance. That's why in today's video, we'll explore not only what experts like Raoul are saying, but also actionable strategies for navigating the complex crypto landscape. Before we move deeper, I want you to take a moment and think about your personal goals and risk tolerance. Every investor has different objectives, whether it's long-term growth, short-term gains, or preserving capital. Some people are comfortable with drawdowns and can buy more during dips, while others need to protect their capital for personal expenses. Understanding your own position is critical. It's easy to get caught up in the excitement of a rising market or panic during a drop, but having clarity about your financial situation will help you make better decisions. As we continue, I'll break down examples from past market cycles and explain how you can apply these lessons to XRP, Bitcoin, and other assets in your portfolio. Continuing from where we left off, let's talk about what Raoul has observed about individual investor behavior and market cycles. One of the biggest challenges in crypto investing is understanding human psychology. People react differently to market drawdowns, and this often dictates their actions more than the fundamentals. Some investors panic during a small dip and sell, while others see it as an opportunity to buy more. Raoul emphasizes that experience matters. He personally did not reduce his positions during the last cycle. Instead, he added more. For many, this approach may seem risky or even impossible, but the key is understanding your own financial capacity and risk tolerance. If you can handle drawdowns, buying during market dips compounds your gains over time. It's simple math. More capital in the market during upswings creates exponential growth. The mistake most people make is reacting emotionally rather than strategically. Raoul also talks about the importance of cash flow and liquidity in managing investments. He points out that having businesses or other income sources provides flexibility, allowing you to stay invested without needing to cash out during a downturn. This is a lesson every investor should take seriously. If you rely solely on your crypto holdings for immediate expenses, you're forced to sell at the worst times. But if you maintain separate income streams or cash reserves, you can let your investments grow uninterrupted. This approach mirrors the philosophy of legendary investors like Warren Buffett or Jeff Bezos, who don't actively hedge or time the market. They let their money compound over time. Compounding is one of the most powerful tools in investing. For crypto, which has historically shown extreme volatility, the ability to stay invested through cycles is critical for maximizing returns. Another point Raoul highlights is the concept of regret and timing. He asks a simple but powerful question. If your assets were cut in half tomorrow, how much regret would you feel? This forces investors to think about their risk tolerance before the market tests it. Many people only realize their limits when they see their portfolios drop sharply, and by then, panic can lead to selling at the wrong moment. A strategic approach is to gradually take profits or reduce risk over time rather than reacting impulsively. In practice, this could mean periodically taking a small percentage off the table or rebalancing your portfolio during market peaks. Over multiple cycles, this method prevents emotional decisions from destroying your long-term growth potential. Historically, we've seen this principle play out repeatedly in crypto markets. Raoul shares his own experience from 2017 and 2020. For instance, he bought Bitcoin at $200 and sold at $2,000, feeling like a hero, but Bitcoin soon rose to $20,000, far beyond his sell point. Later, he bought back near the COVID crash, missing the absolute bottom but still gaining over time. The takeaway is that perfectly timing the market is nearly impossible, even for experts. What matters is consistent participation and strategic compounding. Each cycle presents opportunities, and the next one, according to Powell, could be spectacular. A blow-off top where the combination of rising liquidity, institutional interest, and general market optimism drives prices to unprecedented highs. It's important to note that despite the optimism, short-term volatility remains a factor. Recent geopolitical events, like Iran closing the Strait of Hormuz, have immediate market impacts. This waterway controls 20% of the world's oil supply, so disruptions can create significant uncertainty and cause temporary swings in global markets. Investors need to recognize that these short-term events do not necessarily change the long-term trajectory of liquidity-driven assets like Bitcoin and XRP, but they do highlight the importance of risk management. Understanding both macro trends and short-term catalysts allows you to position yourself strategically. By preparing for volatility, you can take advantage of temporary dips instead of reacting emotionally. Now let's shift our focus specifically to XRP and why it matters in the context of these market trends. While Bitcoin often steals the headlines, XRP plays a unique role in the cryptocurrency ecosystem, especially when you think about liquidity, banking adoption, and global settlements. Unlike Bitcoin, which is primarily seen as a store of value or digital gold, XRP was designed for fast and efficient cross-border payments. This means that during periods of rising global liquidity, XRP has the potential to benefit not only from general market momentum, but also from real-world adoption and transactional demand. For investors, this dual nature, both a speculative asset and a functional payment token, creates unique opportunities that aren't present in other cryptocurrencies. Understanding this distinction is key to making informed decisions in the next market cycle. Raoul's analysis on liquidity and asset compounding also applies directly to XRP. When liquidity increases globally, central banks and institutional investors often look for high-growth, high-liquidity assets. XRP, with its fast transaction speeds and low fees, becomes a more attractive option for both institutional and retail players. This is why, even during periods when Bitcoin dominates headlines, XRP can see significant gains if the market environment is favorable. For example, when large financial institutions adopt the XRP ledger for cross-border settlements, it not only increases demand for XRP tokens, but also strengthens confidence in the network. Investors who understand this relationship can strategically position themselves for both short-term gains and long-term growth, taking advantage of liquidity cycles without relying solely on speculative hype. Another important consideration is the timing of market cycles. As we've discussed, Raoul believes that the next bull cycle could be spectacular, a blow-off top driven by rising liquidity, institutional participation, and renewed market optimism. For XRP investors, this is a critical point. Historically, altcoins like XRP tend to outperform during strong bullish phases after initial market consolidation. If Bitcoin leads the market upward, it often opens the door for high potential altcoins to catch up, sometimes with even higher percentage gains. The key is not to chase every spike blindly, but to understand where XRP fits in the overall market structure. Using historical patterns such as previous halving cycles and liquidity expansions gives investors a framework for identifying optimal entry points. This allows for strategic accumulation before the full bull run unfolds, reducing emotional decision-making and maximizing long-term returns. Risk management is also crucial when it comes to XRP. One common mistake among investors is treating all cryptocurrencies as the same. While liquidity trends may push prices higher broadly, XRP is influenced by additional factors like regulatory developments, partnerships, and adoption milestones. For example, ongoing legal matters or new collaborations with banks can have immediate effects on XRP's price, independent of general market movements. That's why it's essential to track both macro trends, like global liquidity, and token-specific catalysts. A balanced approach, holding XRP for the long term while remaining aware of short-term triggers, helps investors navigate volatility without panic selling or missing critical opportunities. Raoul also emphasizes compounding through consistent investment rather than perfect timing. For XRP, this principle is particularly powerful. Investors who buy during down cycles or dips, even gradually, allow their holdings to benefit from both price appreciation and adoption growth. Over time, this compounding effect can lead to substantially higher portfolio returns than attempting to time the absolute market highs and lows. History shows that those who remain disciplined, stay invested, and understand the fundamentals tend to outperform those who react impulsively to market noise. This strategy also aligns with broader financial wisdom from legendary investors, emphasizing patience, knowledge, and strategic allocation. Now that we've explored XRP's unique role and the broader market dynamics, let's talk about how to act on this information. Understanding global liquidity and market cycles is one thing, but turning that knowledge into practical investment strategies is where most people struggle. Raoul emphasizes that no one can predict the market perfectly, and this is especially true in crypto, where volatility is high and news events can trigger sudden swings. The key is not to eliminate risk completely, that's impossible, but to manage it intelligently. This begins with a clear plan, starting with defining your personal financial goals, risk tolerance, and time horizon. Ask yourself, can I handle a 40-50% drop in my portfolio without panicking? If the answer is no, then your strategy needs to be more conservative, using smaller positions or diversifying across multiple assets. If yes, you can consider a more aggressive approach that takes advantage of market dips. One of the simplest yet most powerful strategies is dollar cost averaging, DCA. Instead of trying to time the market, which is nearly impossible even for experts, you invest a fixed amount regularly, regardless of price. This strategy works especially well with volatile assets like XRP or Bitcoin because it spreads your risk over time. By buying consistently, you automatically acquire more when prices are low and less when prices are high, reducing the impact of short-term volatility. Raoul's own approach reflects this principle. He increased his positions during down cycles rather than exiting the market, allowing him to benefit from the compounding effect of price recovery over time. For long-term investors, disciplined accumulation through DCA can be far more effective than attempting to predict peaks and bottoms. Another crucial tool for managing risk is portfolio allocation. Diversification remains one of the most underrated principles in crypto investing. While XRP may offer unique upside potential due to its utility and adoption, it's important to balance your holdings across other cryptocurrencies and even traditional assets if possible. Risk is reduced when you avoid putting all your capital into a single asset, no matter how promising it looks. For example, pairing XRP with Bitcoin and selected altcoins or with stable assets can help protect your portfolio during unexpected market shocks. Additionally, some investors use a core and satellite approach. A core position is held for long-term growth, while smaller satellite positions are used for strategic trading or short-term opportunities. This approach gives you flexibility without losing exposure to long-term gains. Geopolitical and macroeconomic events also require careful consideration. As mentioned earlier, events like Iran closing the Strait of Hormuz can create short-term spikes in volatility that affect global markets, including crypto. While these events may not change the long-term trajectory of liquidity-driven growth, they can temporarily disrupt prices. Savvy investors prepare for these situations by keeping some cash reserves or stablecoins ready. This allows you to take advantage of sudden dips or corrections without being forced to sell at a loss. Essentially, preparation is about having options. You can stay fully invested, adjust your positions, or deploy capital strategically during volatility. Emotional discipline is another critical component. The market tests patience constantly, especially in crypto, where prices can swing 10-20% in a single day. Raoul emphasizes the importance of avoiding impulsive decisions based on short-term fear or greed. Many investors regret selling too early or missing a dip because they let emotions dictate their actions. Developing a plan and sticking to it, while adjusting only when there's a rational reason, separates successful investors from those who struggle to navigate cycles. Keep in mind that market drawdowns are natural, and over time, the combination of strategic buying, compounding, and patience usually outperforms trying to time the market. Now that we've covered general strategies and risk management, let's focus on personal investment planning for XRP and the broader crypto market. The first step is to be honest about your financial situation. Ask yourself, how much capital can I safely invest without needing it for living expenses? Do I have cash reserves or income streams that allow me to stay in the market during drawdowns? Answering these questions is critical because it defines how aggressive or conservative your strategy should be. Experienced investors like Raoul often highlight that having multiple sources of cash flow gives you the freedom to stay fully invested and take advantage of market dips. Without that flexibility, emotional decisions become almost unavoidable, and that's where many investors make mistakes. Once you've assessed your financial position, the next step is structured accumulation of XRP. Timing the absolute bottom or top of the market is nearly impossible, even for experts. Instead, focus on a disciplined approach. For example, you could divide your capital into multiple portions and invest incrementally over weeks or months, especially during periods of market weakness. This ensures that you're not overexposed during high volatility while still taking advantage of opportunities to grow your holdings over time. Compounding plays a significant role here. By continuously adding to your positions, especially during corrections, you increase your potential upside during the next bull cycle. Historical patterns show that investors who consistently add to their positions tend to outperform those who wait for perfect timing, which rarely happens. Another key principle is gradual profit taking. While it may seem counterintuitive, planning small staged exits can reduce regret during market peaks without losing your long-term growth potential. For instance, you might take a small percentage of profits after a significant rise, leaving the majority of your holdings to benefit from further growth. This strategy allows you to enjoy the upside while protecting yourself from potential drawdowns. The goal is not to hit the exact top, no one can do that, but to balance growth with risk control. Many seasoned investors, including recommend this approach as it keeps you engaged in the market while mitigating emotional stress from extreme swings. It's also essential to monitor macroeconomic signals continuously. Global liquidity, interest rates, and institutional behavior will influence XRP and other crypto assets. As Raoul explains, liquidity expansions tend to favor risk assets, which means the broader crypto market is likely to rise when money printing continues. Conversely, any contraction or geopolitical shock may temporarily suppress prices. Understanding these signals allows you to make more informed decisions. For example, during short-term liquidity tightening, you might slow down accumulation or temporarily hedge, while during expansion phases, you can increase exposure to take full advantage of the trend. Geopolitical events, like the recent developments in the Strait of Hormuz, remind us that short-term volatility is unavoidable. These events can cause rapid price swings in both traditional and crypto markets. As an XRP investor, it's important to maintain perspective. Focus on the long-term trend rather than reacting impulsively. Use these periods to strategically deploy capital if you have the flexibility. Remember, volatility can be your friend if you have a clear plan and the patience to follow it. Let's put everything together into a clear step-by-step blueprint for navigating the crypto markets with a focus on XRP and the broader market cycles. By now, you understand the importance of global liquidity, market cycles, and investor behavior. But turning that knowledge into action is what separates successful investors from those who simply watch the market react. The first step in your blueprint is clarity on objectives. Define what you want from your investments. Are you aiming for long-term wealth accumulation, short-term trading gains, or a balanced combination? Your strategy should align with these goals because it determines how aggressively you invest, how much risk you take, and how you respond to market volatility. Without clear objectives, even the best strategies can fail. The second step is structured accumulation. For XRP and other cryptocurrencies, this means gradually building your position rather than attempting to time the market perfectly. Divide your capital into portions and invest consistently, especially during market dips or periods of uncertainty. Dollar cost averaging, DCA, is a simple but effective method to reduce exposure to volatility while benefiting from long-term growth. Remember, compounding is one of the most powerful tools in investing. Every additional token you acquire during market lows multiplies your potential returns when the next bull cycle arrives. Historical cycles demonstrate that disciplined accumulation leads to stronger performance than trying to chase market tops or bottoms. Step 3 is risk management and portfolio diversification. Even with careful planning, the crypto market is inherently volatile. Allocate your investments across multiple assets to spread risk, and consider holding stablecoins or cash reserves for flexibility. A core and satellite approach works well. Keep a core portion of your portfolio in long-term holdings like XRP or Bitcoin, while smaller satellite positions can be used to capitalize on short-term opportunities or trading setups. By balancing your exposure, you reduce the likelihood of panic selling during sudden market swings, while remaining positioned for long-term gains. Step 4 involves monitoring macroeconomic signals and news events. As we've discussed, global liquidity, institutional activity, and geopolitical developments all influence crypto prices. Understanding these signals gives you the context to act strategically rather than emotionally. For example, a short-term liquidity tightening may require temporary caution, while liquidity expansion periods are ideal for deploying additional capital. Geopolitical events like disruptions in oil supply or tensions in global trade can create short-term volatility. Savvy investors prepare for these events with cash or stablecoin reserves, allowing them to take advantage of temporary price drops instead of being forced to sell at a loss. Step 5 is emotional discipline. Many investors fail not because they lack knowledge, but because they react emotionally to fear or greed. Market drawdowns are inevitable, and it's easy to get caught up in panic selling or FOMO buying. The key is to develop a plan and stick to it. Define thresholds for taking profits or reducing exposure, and make decisions based on logic rather than emotions. This discipline allows you to stay invested through cycles, capture compounding gains, and avoid costly mistakes that come from impulsive behavior. Finally, step 6 is preparing for the next bull cycle with focus on opportunity. The upcoming phase, according to experts like Raoul, could be a spectacular blow-off top. Liquidity is likely to rise, institutional interest will increase, and market sentiment will improve, creating ideal conditions for XRP and other risk assets. Combine disciplined accumulation, staged profit-taking, macro awareness, and emotional control to maximize gains. For those looking to take this further, structured learning programs or communities like the Crusaders Academy mentioned in today's script provide access to detailed playbooks and mentorship, which can accelerate understanding and execution. In conclusion, success in crypto investing is not about perfect timing, it's about preparation, consistency, and disciplined execution. By clearly defining your goals, systematically accumulating XRP, diversifying your portfolio, monitoring macro trends, controlling emotions, and strategically preparing for the next bull cycle, you position yourself for maximum long-term growth while minimizing unnecessary risk. Remember, markets will always have volatility, but those who combine knowledge with action and patience are the ones who thrive. Thank you for following along on We Are Cosmic. Like, subscribe, and stay tuned for more insights as we continue decoding the crypto universe, helping you navigate these exciting times with confidence and clarity.